In this video, we are going to be analyzing EXPI. Now, to get straight into it, we do have a trade plan associated with this as well, which we will be going through secondly. But first, we'll go over the key levels that we're paying attention to and how we're formulating this trade plan around that. So what you can see is obviously big move. We were at around $11. We're now near enough up 100%, near $20 in the space of probably about a month or so. Yeah, in about 42 days. So a massive move on EXPI. Now, how can we look to trade it? What are the support and resistances? So you can see on the right, we have a 1 year chart. On the left, we have a 6-month chart. So we can see at 1650, we have a support. At 1725, we have a support. We're basically holding our third deviation support at 1825, and if we go any higher, we have basically $19. That is our third deviation on the 6 month. We can see we temporarily broke above this level, and if we did go higher, we would have $19.95 and $20.50. But overall, those high levels don't matter. My main focus is going to be on these two levels here, the $18 and 20 cents, which again, we will highlight these in color to make everything a lot clearer. And that level is actually about $19. So we'll put these both down. And again, when we're looking at 6 months, we tend to just use a dash line to make everything a bit clearer. And that's actually $18.95. So what we can see is obviously these two levels are the main focused. So again, just wanted to note those out so they're clear to understand. And what you can see obviously from the intraday range, that's this area here. One thing to note, actually, because I forgot to mention it in the video, is firstly why this stock is moving, and that's because it is getting added to the S&P Small Cap 600. Now, this is important information because when a stock is added to here, ETF companies need to buy it. So this stock is going to push up in price like we kind of see now, and it will stay somewhat elevated because of that. Tends to get a bit more of a pump. Then once the institutions buy it, again, you'll kind of get that another move, but then you'll start to see it kind of start to fall because investors know they're going to have to pay whatever price it's at. So that will lead to the price increase. So again, if you're trading this, even like me, I'm going to be taking a bit smaller size just because we got that fundamental catalyst. There is a reason for it to be elevated. And yes, you kind of move on the anticipation or knowing that companies have to buy it. But overall, you probably will still see a decline in price overall. But anyway, this stock is going to be volatile. So by defining that risk, even if it goes against us, even if we trade 2 contracts, it's $40 risk, not the end of the world. But from even the volatility, a fall in price at intraday, we could be looking to, make that $40 or $80 quite quickly. And again, then if we do get a proper crash on the stock or just a proper pullback, then again, we can be looking at a few $100s of upside. So just wanted to throw this in so it wasn't left out the video. So what these third deviations mean is, if you understand standard deviation channels or standard deviation in general, 99.7% of data should trade within its third deviations. So once the stock starts to trade above this level, that should be less than 0.03% of data. Now again, it's a stock market, nothing's going to be that accurate, but what it does mean is it's a good and high probability that we do start to pull back. So if we can get even a 1-to-1 risk reward on a trade, just to say if it pulls back, that is going to be my trade plan, and that's exactly what we have set up on EXPI. So to go through the trade plan side, again, these are going to be the key support and resistances. If we hit these, they're going to be targets or areas to play the pullbacks if you're, depending on your trading style. And again, obviously these can be supports on the way down if you're trying to either lock in profits as a short or you're trying to catch these long bounces as a trend trader. Or a long bias trader. So they're obviously the key levels to be paying attention to. But to go over the trade plan now, obviously we're looking at the option expirations. That's why I like this stock, because firstly it's easy to borrow and it has options. Being easy to borrow means we can go through a covered stock strategy, which is probably my favorite way to trade it. Does mean you need to put more capital on the line. Doesn't mean your risk is any more, but you do need to actually physically buy the shares. So if you don't have as much money in your account, you can go through vertical spreads as a way to trade this in the same way, but usually you'll be paying a bit more for the trade, and sometimes the upside isn't as great. But again, it's just one of the things, if you've got less capital in the account, that's how you're going to have to trade it. But we do have the money to be able to short this. So again, as it's around $19, how are we looking to trade this? So my main focus is, okay, I'm going to go out. We could go out 8 days, but then it only gives it a week to play out. That's one way we could potentially play it, or we can go out 44 days and play this strike. So again, that's going to be more, up to more of you as an individual, whether how long you want to hold this trade or how quickly you think the reversal could potentially happen. Because again, this just gives you more time trading this, but it's going to make the trade more expensive. This will be cheaper, but there's less time on the trade. So again, we'll run through both of these because again, they're going to be quite different depending on how you want to do it, but the overall trade setup is the same. So firstly, if we want to go 8 days out, again, we'll probably still be looking at the $17.50 strike. The reason I like doing this is because for this strategy, we short the shares, we buy a call. But what it means, I like getting a strike below where we are now, because if it, let's say the stock expires now, what it will do is buy the shares automatically and it will cover our short, so we don't even need to worry about one filling and not the other. So my main focus is going to be on this 1750 for now, and then all we would do is go to the 1750, we click, well actually you would have to have it on covered stock, if not you just press short 100 shares and then you look to buy the 1750 call. But in Think or Swim you can get it done automated for you, and then all you would do is go over to the bid side on the calls, and then you would click the bid on that strike, and then what you can see is it will automatically set up the trade for us, short the 100 shares while buying the calls. This is important, especially buying that call, because what that does is it defines the risk. So now if we go to analyze the trade, what you can see here is if it goes against us, so if it continues up, say it goes to $25 or whatever, doesn't make a difference to our risk. You can see no matter what, there would be $27 of risk on that trade if it goes against us, which isn't too bad. Now, if it starts to go our way, we can see if it went down to $12, for example, you're up 500. So you basically have unlimited upside. You have a set and defined risk, and that's why I like trading this strategy. And again, this is looking out 8 days. So we can quickly go through this now. Again, current price is $19, or roughly around $19. Can't see the exact price actually. There we go, yeah, $18.85 is the exact price now. So what we can see is, again, right now, this is where we're getting into the trade. This accounts for if at expiration. So this doesn't include if you're trying to close the trade early, but it's saying by if at expiration, it only goes to $17.50. $17, you're going to be up about a 1-to-1. Now that is a relatively big move if we're looking to trade it to expiration, but again, that's kind of the price you pay to have the defined risk, and which I'm completely happy to pay. But obviously, if it moved to $17, say today or tomorrow or even early next week, you will be up a lot more than it actually says. Like at $17, you won't actually be up $25. You'll probably be up $100. Because again, it's the change in premium. There's still going to be money in the call, so it's still going to be worth something. And plus, you're making all the money on the short shares. So, firstly, that's a defined risk. That's a trade setup. So you can see in this scenario, if we unlock it right now, we would have a max risk of $30. And obviously, if it goes our way, we have pretty good upside. Now, this expiration is going to be good if we think the reversal is going to happen quicker, because again, then we're spending a lot less on the call, so the short shares will make or kind of be more profitable. Now, so that's to cover the kind of short expiration going out 8 days. Now to quickly cover the longer expiration, so 43 days out. Again, we do the same thing, short the 100 shares, buy the call, but we're going out to a further expiration. And what we can see now is how much are we risking. We're looking to risk around $100. So on this, you're paying about 4 times as much, 4 times the price on the risk front. But again, then it gives you about another month for the trade to work out. And especially in a trade like this, where you are overbought, if you maybe aren't sure if it's going to happen instantly, but you're still pretty sure it will happen within the next month or two, then again, that's when going for those longer expirations can make much more sense. Yes, you're paying an extra $75 per 100 shares you're shorting, but again, it gives you so much more time on the trade. And that's what I mean. It's going to be more down to you as a trader, what you would probably prefer to be looking at. But considering we're at basically $19 now, again, there's still a lot of time, whether we're looking at the 8 days or the 43 days. But just wanted to go through this. We can see as well the premiums do change quick, so when we're trading this, we tend to set limit orders out. You can see it's already gone down about $10. So when we're trading this, we would have limits out. You could probably be looking, if you were executing it you know, within the next 10 minutes, you could probably look to get a fill around $75 max risk. So 3 times what we're looking at on the 8-day. And then again, if it goes our way, we're not going to be up as much because you're paying more for the call, but you're still going to be up a very decent amount at around $12. You're still up $4.70. Again, that's at expiration, not if we get there before. If we get there before, you'll be up a lot more. So that's the way I look to trade it anyway. We're at around $19 now. If I'm looking at it short bias, again, I'm probably going to go with the 8 days out. Just because I think it will either happen quite quickly, and if not, then I can look to re-enter on the new premiums anyway. It's not going to make a massive difference, so I will probably go for that kind of closer expiration, 8 days out, and then we can see again how much is the risk going to cost us. Right now about $20 max risk for the potential upside isn't something I'm not going to be complaining with. So yeah, I probably will be going for the 8 days myself. So again, that's the trade plan. That's how I'm trading it. I'm going to personally go with the 8 days out expirations. Thank you for watching. If you enjoyed the video, you will probably enjoy this video too.